In the last month, the market rebounded harder than Wilt Chamberlain and saw a massive surge. But despite that, in this video, I'm going to hone in on 3 dividend stocks that still look attractively valued and seem like particularly great pickups for your portfolio as we head into this upcoming month here in December. But before we get to those, in case you're new to the channel, my name is Ryan, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Also, leave me a comment below and let me know which stocks you currently have your eye on. I'd be curious to hear what you think is looking good. The first one on my list is going to be Chevron, which has moved in the complete opposite direction as the rest of the market this last month after reporting some mixed numbers in their recent quarterly earnings report, which came shortly after announcing a $53 billion deal to acquire a company called Hess Corporation, which also had a negative impact on the share price. Looking at their performance in the last month, we can see Chevron has seen quite a drop to the tune of about 11.4%, which brings them to a year-to-date loss there of just over 17%, which has them sitting right there, just a hair above their 52-week low. Now, although Chevron has pretty much fallen off a cliff this last month, interestingly enough, this is still the best performing stock in my portfolio by a long shot. I really lucked out with Chevron. And taking a look at my position here on my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to download this in the description of the video. But here we can see I have 13.25 shares of Chevron at a killer average cost per share of $93.54, which is so far below the current share price of about $144. And if we scroll over here looking at my return, this leaves me with a 54% gain just in terms of share price, but on a total return basis, if we throw dividends in that calculation, I'm up closer to 70%. Now, because Chevron's current share price is still so far above my average cost per share, I'm personally going to just hold for now. I don't have any plans to add any more to my position at this time. But having said that, if you're looking for a new stock to add to your portfolio, I think right now could be a pretty good time to consider Chevron, seeing as it's currently sitting near its 52-week low, and by buying now, you'd be getting a pretty sweet deal in the dividend department. Taking a look at this, Chevron has some really solid dividend stats all around, starting with the yield there coming in nice and high at about 4.2%, with a payout ratio that's really not too shabby, kind of middle of the road, actually on the lower end at about 43%, and then the 5-year growth rate's pretty moderate at 6%. I do like to see that, and they also have a very extensive dividend growth history of 36 straight years, which makes Chevron a dividend aristocrat. Anyway, moving on to this second stock that I think could be a good buy coming up here in December, we're talking about the Hershey Company, which has been reduced down to a share price that we haven't seen from the Hershey Company for nearly 2 years. Taking a look at their share price performance, in the last month, it's not really anything crazy. They're down less than 0.1%, but looking at their year-to-date performance, guys, they are down 15.5%, so a much bigger drop in 2023. And if we zoom out to the 5-year period here, like I said, at a current share price of about $191, we haven't seen the Hershey Company at this price for nearly 2 years. It's been since about February or January of 2022. But anyway, having been around since the late 1800s, the Hershey Company is a legendary business with an incredibly strong brand, significant global presence, and an extremely diversified portfolio of products consisting of not only the timeless candy that we all know and love, but also a growing lineup of snack foods like Dots pretzels that I personally might have a slight addiction to. The opportunities to buy a business like this at such a price are pretty few and far between, so if you're looking for a steady, sleep well at night stock to add to your portfolio, I think this would be a good one to consider, especially if you're looking for something that can offer ample dividend growth, which the Hershey Company does. And we'll take a look at that in just a moment, but starting here with their dividend yield, this is coming in at almost exactly 2.5%, so a very average dividend yield, but this is 22% above the company's 5-year average, so I do think that's a good sign. And then taking a look at the rest of the stats, like I said, the Hershey Company offers ample dividend growth with a 5-year CAGR just above 10%, really sweet to see, and the payout ratio's in a great spot as well, coming in at just about 45%, and the dividend growth history is not too bad either at 14 straight years. And then moving on, this brings us to the third stock of the day. We're talking about Johnson & Johnson, which is one I'm really excited about, and I've actually been adding more to this one lately in my own portfolio. Taking a look at my position here, I have 24.25 shares of Johnson & Johnson at an average cost of $162.48, which is still quite a bit above the current share price. And if we scroll over here, taking a look at my return, this leaves me with a 7% loss, which is not too bad, but this does present an opportunity to buy some more shares and bring my average cost down even just a little bit, and that's an opportunity that I want to take advantage of while I have it. Anyway, taking a look at J&J's share price performance, as opposed to the last 2 stocks we've seen, this company is actually up in the last month, but not by much at all, only 0.1%. But if we zoom out looking at their year-to-date performance, in 2023, they are down 15.36%, so they've seen quite a drop, and right now they're not too far above their 52-week low. And jumping over to the dividend stats, this drop in share price has pushed the company's yield up to 3.16%, 8%, which is really nice to see, and this is also 17.25% above the company's 5-year average yield. And then looking at the rest of the stats, everything is looking shipshape here. Payout ratio right at about 45%, not unlike the last two companies we've looked at. The 5-year growth rate is coming in here pretty moderate, 5.8%, not too bad, but the dividend growth history is where J&J really shines at 61 straight years, making them a dividend king. So as you can see, just an incredible track record there with the dividend, and I think all three of these companies would be great contenders if you're looking to make some additions to your portfolio. But having said that, there are still so many stocks out there that I think you need to keep your eye on. The first of which is going to be AbbVie, who's seen a nice 5% drop in the last 30 days, and zooming out looking at their year-to-date performance, they are down 14.75%. Next up, I also think you should keep your eye on Altria Group, who's down 3% in the last month, and looking at their year-to-date performance, they're down 9.5%, and that yield is getting pushed up nice and high, currently sitting at about 9.5%, guys. Really sweet. And then this third stock to keep your eye on is Pfizer. They're down 2.7% in the last 30 days, and year-to-date, they are down a whopping 41%, and sitting right there at their 52-week low. But also look at that yield coming in at 5.4%, really high for Pfizer. And then next up, we've got the Charles Schwab Corporation, SCHW, who's actually seen a really substantial gain in the last 30 days. They're up double digits, just over 10%. But still, if we zoom out looking at their year-to-date performance, this company is down 31.7%. So overall, they're still seeing quite a big drop. Anyway, moving on, next up is the J.M. Smucker Company, SJM, who's pretty much flat over the last month, up 0.3%. But zooming out looking at their year-to-date performance, they're down 28.73% and are right there at their 52-week low. Along with that one, guys, keep your eye on Hormel Foods, HRL. They're up 3.8% in the last month, but year-to-date, they are still down nearly 29% and are not too far off from their 52-week low, so keep your eye on this one. And I think you should also be on the lookout for Tyson Foods, TSN, who's up 4.2% in the last 30 days, but looking at their year-to-date performance, they're still down 24.5%, and like the rest of them, they're not too far off from their 52-week low. Anyway, moving on, keep your eye on AGCO. This is a company I've talked about here and there on the channel, but in the last month, they're up 0.65%, nothing too crazy, but year-to-date, they are still down 13.4%. And once again, guys, I know I'm sounding like a broken record with this, but they are right there at their 52-week low. Anyway, next up, I think UPS is still one to keep your eye on, guys. In the last month, they're down 0.25%. Nothing too crazy there, but zooming out, looking at their year-to-date performance, they are down 14%. And holy cow, look at that dividend yield sitting nice and high at 4.3%. And then these next few we're going to talk about, guys, are going to be some real estate investment trusts. I still think there's quite a handful that you should keep your eye on. Starting with one of my favorites here, this is KRC, who actually had a pretty good month. They're up 6.35% in the last 30 days, but still zooming out, looking at their year-to-date performance, KRC is down 20.8%. So overall, they're still seeing quite a big drop. And also, Vici Properties, I definitely think is one worth considering. In the last month, they're up 3.75%, but year-to-date, they are still down nearly 10%. And then next up, I think this one is going to be kind of hit or miss with some of you guys, but I think WP Carey is at least worth considering. They've had a really solid month. In the last 30 days, they're up 10.5%, but still year-to-date, they're seeing quite a big drop. They're down almost 25.5%. And then next up, of course, we had to talk about Realty Income, aka the monthly dividend company, who also had a really strong month, up 8.4%. But year-to-date, Realty Income is still down over 16%, so I definitely think this is one worth considering, especially at a current share price of $53.31. Now, those are all of the stocks that I think may be good buys right now, and in this next video, I'm telling you about 4 more that are the opposite, and I'm actually planning on selling out of these in my portfolio. So click right over here to find out which ones they are, and I'll see you in the next one.